to move on and have a look at our second financial statement, which is balance sheets. Balance sheets show the financial position of the business at one point in time. It's like taking a picture or photograph of the business on a given day. It's showing what they own and how they paid for it, what they controlled and what they owed to other parties on that particular day. So as I said, it shows what the business owns and how they paid for them. And it's based on this accounting equation of assets equals liabilities plus owner's equity. So how do we know what we're looking at is a balance sheet? There's a number of key features that we need to be aware of. First of all, it's going to have the words as at in the title. Secondly, it's going to include assets, which can be broken up into current and non-current assets, liabilities, which can also be broken up into current and non-current, and finally, it's going to have owner's equity. However, probably the most important feature and characteristic that you need to remember is that both sides of the balance sheet are going to equal. Let's have a look at a balance sheet now. First thing we need to remember is it's going to have those two key features. It's going to have the words as at in its title, and total assets have to equal total liabilities plus owner's equity. So an asset is something of value that the business owns or controls. They can be broken up into current assets. Now, current assets are a type of asset that are likely to change in value or have their benefits consumed completely within the 12-month period, as opposed to non-current assets, which is unlikely to have its value change or its benefits completely consumed within the magic 12-month period. Now we move over to the other side of the balance sheet. Our liabilities are amounts of money that are borrowed from outside of the business that must be repaid at some future date. So liabilities is just another word for debt finance. Current liabilities are funds that have been borrowed that must be repaid within 12 months or less. So they're our short-term debt finance. Our non-current liabilities, however, are funds that are borrowed from outside the business that don't have to be repaid within 12 months. So they're our long-term debt. The final thing that we need to know is our owner's equity, and that's the owner's claim in the assets of the business. Remember, you have to know the accounting equation of assets equals liabilities plus owner's equity. What the business owns has to equal how they paid for it. And more often, the HSC is getting you to use this equation to find missing figures. So let's have a look at Alyssa's Angels to see how we can use the accounting equation to solve and find some of these missing figures. Let's start off by looking at the missing value for inventory. We know that our total assets are 3,400. Out of that, 2,600 are our non-current assets. We know between cash and accounts receivable, we've already got 600 in our current assets. So to get to the 3,400 needed, we need to have another 200 in our inventory. Moving over then to have a look at the missing figure for total liabilities and owner's equity. It's a balance sheet. So we know if our total assets of 3,400, total liabilities plus owner's equity have also got to be 3,400. Now that we've got this total, we can work out what the mortgage is. If we know that total liabilities plus owner's equity is 3,400, we already have 400 made up of our current liabilities and another 2,000 in capital. So we're already at 2,400. To get to the required 3,400, our mortgage must be 1,000. Remember, you have to know the difference between current and non-current assets and liabilities. The magic number here is the 12 months. Current assets will change or be consumed within 12 months, and current liabilities must be repaid in 12 months. Whereas non-current assets, they don't have to change and won't have their benefits entirely consumed in that 12 months, and the non-current liabilities don't have to be repaid in full within 12 months. So in summary, a balance sheet is going to show the financial position of the business at one point in time. It's going to show what the business owns and how they paid for it. The key features of the balance sheet are going to include having the words as at in its title. It will include assets, both current and non-current, liabilities, again, which are current and non-current, as well as owner's equity. And most importantly, both sides, the total assets, will equal the total liabilities plus owner's equity. It's based on the accounting equation of assets equals liabilities plus owner's equity, and you really need to know the difference between current and non-current to be able to move forward and use some ratios based on this financial statement.